Hey guys, Jordan from Condo here. Really quickly today, I want to go over a 5-minute market update. Last one I did was, I believe, a few weeks ago. It is now May 30th, 31st rather, and the housing market continues to pick up. So the resale market continues to trend towards the seller's market. We're starting to see bidding wars. Bidding wars are back, and they're the norm on. They seem to be the norm, at least, for entry-level condos and even some mid to luxury level condos. So let's get into this. Some recently sold examples to start us off. Pier 27, unit 1014. This unit was listed for $2.1 million. It sold for $2.15, so $50,000 over asking. It received 2 offers the same day it was listed. It's a 1,500 square foot, beautiful 2-bedroom corner layout with a full view of the water. What I love about this unit is it shows that the luxury resale market is picking back up. In times of economic uncertainty, the first market segment that takes a hit tends to be the luxury segment. It also tends to be the segment that takes the longest to recover. And so the fact that we're seeing multiple offers on $2 million units, tells you where the market's currently at. Things are heating up really quickly. If these trends continue, we're going to be at February's highs in no time. 155 Yorkville, this one was listed $399, ridiculously underlisted, would never sell for that price, but regardless, sold with multiple offers for $575,000, $175 over ask. 233 Carla, this one listed at $499, it sold for $585, 7 days on market. 59 East Liberty, listed 1.2, sold 1.2, 2 days on the market. 168 Simcoe, listed $599, sold for $590, $9,000 under asking, 1 day on market. 38 Grenville, listed $638, sold for $670,000. Maitland, listed at $680 and sold for $742. Jarvis, listed at $450,000, sold for $467. 100 Western Battery, listed $800 and sold for $875, 4 days on the market. Another on Western Battery, listed at $500 and sold for $535, 7 days on the market. So bidding wars seem to be back. They seem to be the normal, especially on entry-level condos. We're seeing a ton of units selling for well over ask in the last few days, especially in the last 2 weeks. It's been picking up massively. When you look at the showing trends, so showings are back to about 55-60% of how active showing activity was in February. Despite the fact that there are a lot more conditions on showings now, so you got to wear masks, you got to wear gloves, you got to sign a waiver. So it's a little more cumbersome than it used to be to have showings, but there's a lot of buyers, there's pent-up demand. We're feeling it. We've sold a few units in the last week, 1 pre-construction, couple resales. So we're seeing it on the ground. There are way more buyers active in the market right now than there was just a month ago. So if you look at April versus May, showings are up over 100%, offers are up over 100%, and solds are up about 51%. So ton of activity flourishing back into the market. We're not at February highs yet, but we're headed there really quickly. And listings are selling for what they were in February and January already. Pre-construction inventory is starting to move again. So we've sold a few. I know some of my colleagues have sold a few as well. Buyers are buying pre-construction once again. And again, like the luxury segment, the pre-construction market tends to take longer to recover than the resale market. So it's a good sign and a good indicator that there's this pent-up demand and buyers are returning to the market. So a lot of people are saying we don't know the full impact of COVID yet, and I tend to agree with that. We don't know how things are going to shake out. These are the institutional reports over the last couple of months, where everybody thinks the prices are going. We've got everyone from TD saying there's going to be a 6% increase over the next year in the housing market, to CMHC saying a 9 to 18%, and Moody's saying an 8 to 30% decrease in pricing. Now, 8 to 30% from Moody's, my understanding is that is a regional thing. The great thing, the thing about the Canadian housing market is Ontario is going to perform far different from Alberta, going to perform far different from BC. In an area like Toronto, where we get 30 to 40% of the net migration, and we're less dependent on something like the oil industry, we tend to see more appreciation than areas like Edmonton and Calgary. And so an amalgamated composite of where prices are going doesn't do a very good job, doesn't really do much justice to explain where the housing market is actually going, because it's so regional. We can have price decreases in Calgary while we have price increases in Toronto, like we have over the past year. So my understanding is that's where Moody's massive range is coming from. It's not that they flat out just don't know and don't want to admit that. It has to do more with being more regionally specific. If you want to know who's been the most accurate, Benjamin Tal from CIBC over the last 10 years has had I think, in my opinion, the best track record out of these guys. And he's saying a 5 to 10% decrease. And I would argue we already saw that. So Toronto condos saw a 4 or 5% decrease over February's highs. So if a listing was selling at, $600,000 in February, you might have been able to pick it up for $580,000, $575,000 in March. That's no longer the case. It looks like the bottom of the market was March or April, and things are picking back up. But the full effects remain to be seen. So this is the median one-bedroom condo selling price. The reason why I filter to one bedrooms and I niche down to one bedrooms is because the luxury market, like I said earlier, it's the first to take the hit and it's the last to recover in times of economic uncertainty, because luxury properties are less required in general, right? Like, people always need homes, but the luxury properties above 2 million are the first to take the hit and in times of economic uncertainty. And so when you see the media running with median and average selling price and they're saying it's down 20%, of course it is. You're not filtering, you're not adjusting for the fact that luxury properties aren't selling anymore, and those drag up median and those drag up average. So when you filter down to one bedrooms, you see that, prices really didn't take that much of a hit and they're headed back up already. One thing I do want to point out, over the long term, over the next year, while we start to see where things really shake out in the housing market, most of the people who there was a ton of job loss in Canada, but most of it was part-time and most of it was full-time, low-paying jobs. Those are people who, at least in Toronto, couldn't really afford into the housing market anyways. So in Toronto, with an average condo selling price of $600,000, you really do need to have a household income of six figures in order to get into the market as a first-time buyer. Unless you have a huge down payment, help from family, that kind of thing. So the people who were looking at condos in January, most of them didn't lose their job. 99% of them are still, they have a secure, high-paying job, and nothing has changed for them. They just maybe were spooked by the market, and now we're seeing those buyers return to the market overwhelmingly. So one thing I like to remind people, and I tell this to all my clients, real estate's not a one-year investment, right? You're not looking to sell and make, you're not looking to buy today and sell it this time next year and make money. Transaction fees are high. It's a stable asset. It's a hedge against inflation, which is a great point. Today when we're printing money, and inflation might be something on the horizon. Having hard assets is much better than having cash in your bank account where it can depreciate. So it's a 5 to 10 year plan minimum. You want to make sure that you're buying that real estate to hold it for at least 5 to 10 years. Predicting housing prices next year or the year after is kind of a fool's errand. The better thing to look at is the trend. Where are we headed? Are we immigrating more people than homes that we're building? And will that support price growth? And the answer for Toronto and Montreal is, of course, yes. We're not building enough homes. We're immigrating a ton of people, and so housing prices are going to continue to trend up. Just for point of comparison, if you had put $75,000 down, which is 20% down on a $365,000 condo, and you did that back in April of 2015. That condo would be worth about $641,000 today. So you would have earned $275,000 in capital gain over the last 5 years. By comparison, if you had bought $75,000 worth of the S&P 500 back in April of 2015, and you put that money in the stock market, let's say, best case scenario, you're a genius, you knew the market was going to crash, and so you sold in February. You sold at the all-time high of the S&P 500. You would have only made $45,000 in the S&P 500. So obviously that's the power of leverage. You're putting 20% down to control 100% of an asset, and there's risk. Leverage up is also leverage down. But when you're buying into a place that's immigrating more people than building homes, of course, over the long term, you're going to see price appreciation. The adage holds true in most markets in Canada. Property values double every 8 to 10 years. And this is, like I said, we immigrate far faster than our neighbors to the south. And when you look at the housing appreciation of Canada versus the US, in the US they see the median housing prices in the US is about a 3 to 3.5% appreciation year over year compounding. In Canada, we're seeing about 6 to 7%. Then of course you've got regional markets like Montreal and Toronto that are seeing 7 to 9% year over year. Because that's where most of the immigration goes. When you're only building 200,000 homes, but you're immigrating almost 500,000 people over a long enough time period, prices are only going to trend up because it comes down to basic supply and demand. And yes, wage growth needs to happen. And yes, cities, we need to grow more cities outside of just Toronto, Vancouver, and Montreal. But regardless of all of that, over a 5 to 10 year period, you're going to be really hard pressed to lose money on real estate. So where prices are going to go tomorrow, I'm not really concerned with. I think we're seeing a ton of buyers flood back into the resale market, and that's great. That's healthy. The pre-construction market is picking back up as well. I think if you were looking for the bottom, if you were looking to pick up properties at a discount, I think that time has came and went already, at least for Toronto. That remains to be seen, but definitely, trying to time the bottom, trying to time the market is kind of a fool's errand. The best case scenario is just buy in and hold for 5 to 10 years. Ideally hold for 20 years, just refinance the thing and buy again. But, you're looking over a long-term period. You're not looking for short-term gains in the real estate market.